is the Financial Thought Exchange podcast, where you learn from the leading thinkers in finance. I'm your host, Lotta Moberg, and my guest today is James Grant, whom many of you already know as the founder and editor of Grant's Interest Rate Observer. He's known as a deep thinker and commenter on markets and economics, and he's authored numerous of books. Just to mention a couple of them, Money of the Mind, which is the history of borrowing and lending in America, and as well as The Forgotten Depression, about what transpired in 1921. He's also written biographies of John Adams and Walter Bagehot. We're really happy to have you here, James. Welcome.
Thank you, Amanda. It's nice to be here.
So good to have you. And this is actually part of a two-part, the first part of the two-part conversation. We'll talk today about interest rate fundamentals, and the second part will cover more on what a U.S. debt situation is and what a debt default could entail. So stay tuned. Check that out if you like this conversation. So I'm really happy that I'm going to finally get all my questions answered about interest rates that I've always wondered about with the expert. So just to start off, I want to ask you what interest rates are. We all know that it's the price you have to pay. It's kind of a price for time, but the price is one thing, and the value that underlies it, I'm thinking, is another. What is your general framework? How to think about what interest rates stem from the beginning? Is it a productivity factor? Is it this myopic, we want something today rather than tomorrow factor? Or is it something that simply central banks create?
Scarcity, I think, lies at the heart of the rate of interest. And time is scarce. Uh, Heartbeats are scarce. And so opportunity cost and time and scarcity all figure into this. Superficially, the rate of interest is the cost of borrowing. And that is good as far as it goes. But look a little bit deeper, and I think what we can all see is that the rate of interest is kind of a reward for foregoing something in the moment uh, in exchange for earning a rate of return that you judge to be appropriate over the longer term. So if it weren't that case, there would be, if we weren't impetuous creatures, we human beings, there would be no Amazon Prime. There would be no drones flying around delivering you things you actually didn't need at all, let alone in the next 6 hours. But we are impetuous, we consumers. And interest rates reflect this impetuosity of the human creature. And so as to the fundamental nature of interest rates, I am drawn to the opportunity cost element and the scarcity element, and there's a moral dimension in interest rates as well, which I suppose gets us into a somewhat different, subtly different field of credit, which is the promise to pay money and the expectation of receiving it, and and so there's something called a pure rate of interest, right? And that typically is the shorthand for the sovereign's promise to pay, and that we take to be a pure rate of interest. But no, there's no sovereigns are governments, and governments know as well as we that the shortest distance between 2 points is a straight line, which is not always the most morally commendable distance, right? So the whole history of borrowing and lending to sovereigns is one of default and prevarication and shambling, shabby defaults, by any other name, inflation being a form of default. So a rate of interest seemingly is very simple, but as you can hear me rambling on, there are many facets to it. And uh, and in the end, I think they are They are highly related, highly conjoined together. And with respect to the United States, I guess I'm now dangerously close to trespassing on our second hour. But the pure rate of interest of the United States Treasury is increasingly one of a consideration of credit that is to be paid. As to if you extend a loan, you expect to be paid in good money and on time. Right? That is the essence of uh, of man's confidence in man. But as we will see in hour two, as a little preview, um, there is something called the credit default swap on the United States of America, which is telling a very different story than that of the pure interest rate without any consideration of credit risk. So, what I have meant to describe to you in my 15-minute prologue here is is the essential nature of interest, which is having to do with time and scarcity and foregoing an immediate desire for pay. And that pay we call the rate of interest.
So at its core, I feel like you're emphasizing the productivity factor, right? Like you wouldn't have interest if we weren't growing in productivity. If we didn't have productivity growth, and then on top of that, so that's I feel. I wonder if you then say the pure rate or interest, does that kind of assume an interest that removes the credit risk part? Then, so it really focuses on the productivity factor.
Yes, although I'm trying to think back to the great economist who posited that the rate of interest is inherent in nature, that nature grows.
Hmm.
And I don't know what the more I am around credit instruments, bonds, loans, and the like, the less I am of the view that there's any such thing as a pure rate of interest, uncontaminated by the element of credit, especially now. I mean, the holder of the title of the world's reserve currency, the president of this country, is someone who, in his former private life as a real estate promoter, had extensive and rather merry experience with serial defaults, undertaken without much moral compunction. So here I am once again trespassing on hour two. But let me just say that I think that there is if there is a pure rate of interest in the world, it is a very rare thing that most interest rates have a counterparty risk or credit risk attached to them. But it involves time, involves scarcity, it involves the patience to wait for what one wants now. From the lender's point of view.
Yeah. Yeah, so I'm very sympathetic to that. There, you do say a couple of things there that can be separated in the end there, because one thing is patience, and the other one is productivity. In a way, I've been arguing too that you really, whenever you have the stylized examples, right? People will argue that interest rates exist because we're myopic. We always want something today rather than tomorrow. Like if I get you a burger now versus tomorrow, which one are you gonna want? I'm gonna want it now. I feel like that proves anything because there's a risk component. Even if you say, I promise you tomorrow, like if I'm alive tomorrow, there's always that risk premium that things might not transpire. There might be a world war, all of that, which makes me think that if you remove productivity growth, and in theory, which can never be true, right? Remove the risk factor, they wouldn't necessarily be an interest rate.
Well, I think if you look back at the history of interest rates, that tome by um, Dick Silla and Sidney Homer, spanning from what is it, 1100 BC to the present time, it's 3,000 years of history. You can look at periods in which there was very little material progress and hardly measurable productivity growth, and yet interest rates have always been with us. So I think the productivity is an interesting element of all this, but I dare say it is not a dispositive or essential one.
Right. Yeah, I mean, and that was a world with a lot of risk, right? Like, chances that you die in cholera tomorrow is was way higher at that time, so even higher, right?
Right. Well, I would say that this is a world of considerable risk, and that we have gotten out of the practice of being cognizant of that risk by a run of fabulous good luck that it's not all good luck, but my goodness, if you look at if you were to conceive a graph of kind of a composite rate of material well-being, and that let's see, we combine material well-being with a graph of uh, of expectation about well-being. I think it would describe it would be up and to the right, with that fabulous bull market in the in well-being and the expectation of further well-being. I mean, you hear a lot about. I mean, nobody's happy, right? At the moment, it seems that we have that from the ancient philosophers and the modern ones, that very few are happy in the moment. They're happy about the expectation of great things to come. Very few, except perhaps people who have thought and read some history, and they might, in the course of that reading and thinking, have arrived at the realization that nobody in the history of the world has lived as well as we do in this very instant. And it's quite humbling to think that we are the heirs to so much trial and error and struggle and imagining and invention and uh, and work, and at length the fruit of that work and everything we see, every material object we see around, all that's wonderful and quite humbling. And but interest rates precede all of these things. And so I stand by my notion that we don't really need productivity growth to explain interest rates or the absence of rates. Interest rates were famously, they seem to confound sweeping doctrines of theory, don't they? I mean, to me, the most striking episode of interest rates I've ever read about or lived through was that of 2020 and 21, when upwards of $18 trillion worth of securities, according to Bloomberg, were priced to yield less than nothing worldwide, negative nominal interest rates. Um, short-dated government treasury, not just treasury bills, but 2-year notes. But um, so, who would accept interest rates of less than zero on a nominal basis? Well, people who expected what? Who expected terrible things? Who expected deflation? Yeah, or maybe they were habituated to falling rates by 40-year preceding years of declining rates, and just were projecting that future into the next 10 years, for whatever reason, in one investment lifetime, my own specifically, when I first got into the business, the year was 1967. Or was it 1867, Lon? I forget now. I think it was 1967. And I had just gotten out of the Navy. I was a teenager still. I was now 20 years old. And I went to work on a bond trading desk at McDonnell and Company in Lower Manhattan, Wall Street. And the long dated security was the 4.25s of 1992. And I learned a couple of things. I learned that when prices fall, bonds fall, yields go up. Okay, I got that.
Mhm.
And I learned that there was no end of money to buy bonds. I said to my friend Lou, I said, Lou, where does all the money come from to buy these? Like Baltimore Gas and Electric is selling $250 million worth of bonds at yield 4.5. Where does that come from? We said, don't worry. There's as much money as there has to be to buy the bonds. So so that was that was an interlude in what would prove to be a great bond bear market. and that lasted for 40 years, 1946 to 2000, no, 1981 to 2021 or so. 40 years of falling interest rates. Now, mind you, during those 40 years of falling interest rates, we had periods of at least perceived um, accelerating productivity growth. Remember the late 1990s, Alan Greenspan was building his entire legacy at the Fed on the notion that there was such a thing as no more such a thing. There's no more such thing as a natural rate of interest, natural rate of unemployment, because the rate of productivity growth was galloping, and you could press um, interest rates lower because the rate of inflation would not be so sensitive to the perception of overemployment, of pressing against the limits of productive capacity because of productivity growth.
Mhm.
And so that was one. And of course, the productivity growth was a thesis that carried stocks to incredibly high levels late in the 1990s and led to the pay down in some public debt in the United States that led people to project the ultimate pay down in all of the public debt and led Alan Greenspan to wonder how the Fed would conduct monetary policy in the absence of bonds. Okay. So that's in my lifetime, and it's not in your lifetime. I can see that it's obviously not in your lifetime, but in a 50-year career, one has lived through all manner of conceits and projections and theories concerning interest rates. They will be longer and lower forever because dot dot dot. Because why? Because material progress and productivity growth will allow. There's a book produced called Capitalism Without Capital 3 or 4 years ago, right? And so you're talking to what's worse than a practitioner on the intellectual pecking order in finance? Oh yes, a journalistic practitioner. that's that's lower still than a practitioner. So I have been I've done some reading and some writing in this area. I'm not sure how much would pass muster with the formidable, rigorous intellects at the CFA Institute. Um, but for what it's worth, I have done all of this work in the public library at home, my own PC typing away, and I have come to see that interest rates are a very difficult subject. Is what they are.
That's helpful. Well, so how would you I mean, the 40 years, if this was kind of a cycle and you're saying it in jest, right? That productivity all of a sudden would have a negative correlation with interest rate. That suggests that the productivity part even did not explain it, or what explained it was the central bank's reaction to a good economic environment.
What explains it, and it fails to explain. For example, um, interest rates are odd little creatures. They have moved in the past in this country, in America, and I dare say in many other countries in the developed world, they have moved in long dated cycles or phases. And one such phase began just after America's Civil War, call it 1870, 1875. And that period is known to some historians as the period of the Great Depression because prices tended to fall, gently, but there was a gentle but persistent deflation. Not so gentle to debtors who struggle to maintain um, their interest payments and not to forfeit their collateral. But there's a period of gently falling prices, but of gently rising real wages owing to persistent growth in productivity and efficiency. It was an age of terrific invention. Imagine if you lived in a time of the invention of the incandescent light bulb, for example, or if the internal combustion engine came to be a thing, and and all of the inventions that were associated with. I mean, how much did productivity growth accelerated with the growth in artificial electric lighting. Wow, hard to begin to imagine it, right? And this led to here I am imputing causation. This was coincident with 25 or 30 years of gently declining rates of interest, 1875, 1900. And then comes 1900. And so, why should interest rates have taken a secular turn to the upside? Because productivity growth was continuing at a ferocious pace in the early 1900s. Yeah, but it did, and people ascribe different things, there are different reasons for that. And one was the discovery of gold in the Klondike in Australia and in the Rand in South Africa. And of course, the world then was in the classical gold standard. Then gold was the monetary base. So more gold, other things being the same, a slightly faster rate of monetary and credit growth. And yes, there was a rising rate of inflation after 1900. And um, who was the great Yale economist of that age? A lot of you no doubt remember him.
Fisher, maybe.
Irving Fisher, yeah. And Irving Fisher was so taken aback by so he was a theory he was of course famously at the Yale Department of Economics, but he was a Chicago guy, got hired, always wanted to model things, and he was a quite brilliant economist. And he thought that rates of inflation of say 2 and 3% were unbearably high, and he wanted to create a special kind of offsetting currency. He has and it's very convoluted currency to tackle that problem. Then along comes World War II and a very ferocious rate of inflation. So anyway, I'm going on much too long about this, but these phases of interest rates rising and falling have persisted for 150 years or more. And I can't really explain why they have persisted. One could kind of impute a little bit different monetary systems to explain that really, not rigorously. But seeing rates rise and fall at generation like phases or cycles over the course of the century and a half, I'm very skeptical of all inclusive reasons for explaining those rises and those declines.
And can we exclude in any way that it is really all about inflation? Because you can't really measure how much of any interest rate is inflation, because you can look at inflation in the past, and then interest rate is a forward-looking measure. And then you can look exposed to see, well, the inflation was actually this when the interest rate was that. And then we call the rest like this real rate, which is sometimes positive, sometimes negative. How much might it just be it's all about inflation? It's all about inflation expectations and perhaps a component of inflation uncertainty as a risk premium on top of that.
I think inflation is a great deal of it, but then you get into the question that's for so-called sovereign securities are meant to be without credit risk. Um, but corporate debt is another thing, and personal debt is quite another thing. But I think if you had to pick one, yes, inflation would be that one.
Well, yeah, we can pair inflation plus risk premium depending on your counterparty, right? A lot of people would say that a US sovereign has a very, very, or if even zero risk premium. So it's that component when we look into going to the credit world.
Yeah, but the U.S. does not actually have a zero risk weighting. If you look at the market in credit default swaps, which we'll get into later, I guess. Um, but the U.S. no is sadly it's what it was his phrase used to be. It's blotched or it's blotted its copybook. The United States has blotted its copybook. First came the downgrade by Standard and Poor's in 2011, and now comes the election of Donald J. Trump, and the credit default swaps are now saying, "Ooh, it's 50 basis." It's a very interesting time in sovereign risk. That's all I'm saying. And yeah, I don't. I don't mean to to quibble with the idea that inflation explains a great deal of, or if not most of the time, of rates and movements in rates. Yeah,
Yeah, I'm just kind of getting to thinking that the big things moving around are inflation and then the risk premium. Risk premium obviously varies depending on the size, often the stability and longevity of the counterpart. And then when we measure it in any way, trying to do it forward looking through like forward swap curves and trying to figure out what the expectation is for inflation, then compare that to rates. Or if you look back historically, this component that we call like the real rate that is absent of the risk premium and inflation, it's just a small thing that it could just be a residual of mismeasurement in the end. It's really hard to be sure that, oh, I'm really measuring, the
yeah.
value of like
This real rate thing to me is the ultimate will o' the wisp. I mean, uh, the real rate gets back to, um, a fellow countryman of yours, a Swede, Newt, Wixel.
Excel.
Yeah.
Yes.
Wixel posited, that there's a natural rate of interest, that, there's like, if the supply of loans equals the demand for loans, absent the intrusion of bank credit, that would be a natural rate of interest, right? And if the nominal rate of interest were suppressed below the natural rate, that would induce a credit inflation. Now I'm kind of, eliding Newt Wixel with a man called Rupke, a nice German neoliberal who has some interesting things to say about this as well. But the natural rate of interest has been around since the turn of the 20th century, but it was fetishized by the Fed last couple of years. And I'm going, Mr. President Williams, the New York Federal Reserve Bank, has made a name for himself by calculating. I think when he's not calculating the natural rate of interest or the neutral rate, he is calculating the number of angels that can dance on the head of a pin. That he does that in his own spare time. But when he's not doing that, he is looking around for the magic formula to calculate um, the neutral or the R starred. Right? I mean, but the Fed, think of all the trouble the Fed has gotten itself into and us into by uh, these mind games. I mean, as recently as 2022, you could read people in the Fed dogmatically insisting that inflation was all about future expectations of inflation. No, it's not. It's looking in front of your eyes. M2 is growing at 22% a year or whatever it was. M2 is through the roof, and they're telling people they got to spend money. They're sending them checks to spend, and interest rates are suppressed. And why do you say it's a matter of expectation? It's a matter of fact, and the facts are no. And it wasn't, and it wasn't here you're a practitioner getting into the dirty little details of everyday life, and you want to have a nice high-minded theoretical discussion. But because of the dogmatism of our central bankers, they wouldn't even entertain the idea that there was something happening under their very nose. Like, look out the window, you guys. But no, they wanted to have their views on they had this framework they posited in 2020. You had to have an average of 2% inflation over the cycle. If inflation were less than 2% over the cycle, you had to make it up. You had to have a make do with more inflation to make it an average inflation rate of 2%. Why? Because something to do with inflation expectations. I They lost me on that one. A lot of grads kept saying, you know, no, they kept on saying yes. And guess who said yes louder than little grass with his journalistic lemonade stand? We kept on saying no, 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 no. And they said yes. They had the bigger megaphone.
Yeah, and it was amplified with a lot of academic research that come out. I mean, that the Williams lawback model is what you're referring to here. That basically has looks like it's got quite a indigeneity into it. It's kind of like where interest rates has been, like, and you draw a line, and that was kind of the justification. Like we have to have rates low because the natural rate of interest is lower now than it has been in the past. So
Right. And if you look at it, this kills me. Now you are a doctor of economics, Lotta. Where you're learning is very likely. It's very becoming on you. But if you read these monographs by the Fed staff,
Mm.
two things struck me. One is that they quote from each other at great length. You look at the notes in the back, right? And one Fed staff member, they're all PhDs, they're quoting from each other. 850 or so of these characters, whatever it is, many hundreds. And they quote from each other, and few of the citations ever antedate the modern age of the PhD standard. I have used a term of art. The PhD standard is monetary policy guided by former tenured economics faculty. That's okay. Um, but they are it's a belly button gazing world, and they have no sense, if I may say so, of the past, no real sense of the history of finance, the confounding history of finance, the confounding nature of finance conducted by mere mortal human beings who will buy high, who will sell low, right? Who will overborrow, will overlend, and will get us into these recurring cycles of boom and bust. None of this comes through in the Fed's research because, I say, they are preoccupied with the abstractions that are so very unhelpful when it regards the human business of lending and borrowing. That was a little that was a that was a little editorial speech.
That's great. And just to wrap up, when we talk about, since we talk about the natural rate of interest, to get really the gist of your view here, it sounds like you're saying there is such a thing, and it would be great if you like find like which definition of the natural rate then
There's a
actually is.
there's true love too, right? There is such a thing as true love. And,
Please
Patricia
clarify.
let me finish. The former Patricia Cavanaugh, I think she's not right, and I've been married for 52 years, 53 years soon.
Congratulations.
And we, with the sheerest of good fortune, it's just blind luck, found true love. Now define that. I don't know. It's you know when you see it, and how do you get there? Well, I don't know, just get lucky, and that's kind of the natural rate of interest, right? Is every once in a while when the wind's blowing properly and you aren't paying attention, you will have arrived. You central banks will arrive at a rate of interest that happens to coincide with the supply of loans equaling the demand for loans in a non-inflationary environment. You will be neither suppressing nor um, elevating artificially the nominal rate of interest. It'll all be in heaven for 6 or 8 months. But
Yeah.
that's not because you have
Sorry.
calculated it, right? It's because it has happened to you.
Well, yeah, I mean, I feel like the analogy would be, I mean, the way you find true love is you go out there in the world and allow yourself to seek it, and you can compare that with arranged marriages. We're in the world where nobody was allowed to talk to anybody, and let's say there's some higher authority arranged us to pair up with each other. Then you would ask, like, what is true love? Well, it's when we get it right, which we do once in a while, and we know that we are less likely to get it right in that sense. So it sounds like the definition that's come closest to what you're thinking about is kind of the Knut Wicksell definition, which is in a free market where people are trading with each other, an interest rate emerges that is like the natural in that way. It's not about employment going some direction. It's where the market lands when it's allowed to operate.
In the day, let's go back to before the Fed's founding, turn of the 20th century, 1900 through 1913 or so. Um, uh, there was a natural rate of interest discovered every day on the floor of the New York Stock Exchange, and it was the margin lending rate for collateralized loans on the stock exchange, whether bonds or stocks. It was very volatile. And it was seasonally volatile too because there was demand for funds to finance the movement of crops from the interior of the country to the seaboard cities for shipment overseas. But that to me was a very instructive period in our financial past because you could see the discovery of this rate of interest in real time, and it was so jagged and like this and this and this, and no attempt to smooth it out. And the very jaggedness of the very volatility of it was a source of bankerly caution and not over lending or over trading, as the phrase used to be, because they could not comfortably finance themselves over the short term for a longer term loan. So banking is all about maturity transformation, right? Borrowing short and lending long. But if you can't predict with any degree of certitude the level of short-term rates as they are discovered hourly, minute by minute on the floor, so that you'll be much more circumspect about the quality of assets you take aboard a leveraged financial institution. So one of the, the kind of uh, the, uh, the subtle costs of a Fed that wants to make everything nice and stable and manage expectations is that people can get comfortable with borrowing short and lending long, and they can get comfortable with overdoing it and with piling on leverage. This is another facet, of course, of moral hazard, but it's one that people don't talk about so much. But the idea of being able to project the short-term cost of credit for fiscal quarters or years. In fact, it exactly explains the regional bank blow-up of 2023. People took the Fed at its word that the Fed, could and would guarantee them a nominal rate of funding cost for years to come. Nope, the Fed could not do that because it couldn't know, despite its protestations, because Lotta, the future is a closed book.
Very good, and a perfect time to wrap it up. I hope that our audience got a very good sense of where interest rate might come from and the central bank's possible role in that. So thank you so much. Thank you so much for being here.
Well, you're welcome.
And if you like this conversation, please tune into the next one when we are looking closer at the U.S. situation and the government debt. It has been. Sorry.
You must tune
Uh, Yes, you must tune in. Otherwise, there will be a penalty of some sort that you foresee as of yet. So thank you so much for tuning in. This has been the Financial Thought Exchange podcast. I'm your host, Lotta Moberg. We have James Scratt with us today, editor of the Grants Interest Rate Observer, and we will see you in our next conversation.
For more information, please visit rpc.cfainstitute.org/research-foundation.